public radio to discuss long-term investing. He has worked with Smart Money, Barron's, Motley Fool, and Money Magazine. The Chicago Tribune, Wall Street Journal, and Market Watch have all covered Mark. Two guys, stocks for interesting time. It's showtime.
Well, thanks, Kathleen. Ken, are you live?
I think so, Mark. Good to be here this evening, this afternoon, I guess. Maybe it's this morning even, right, Mark?
It's earlier than you think, Ken.
Yes, it is.
All right, well, I'll kick us off. You can take the next slide, but I just thought I would make the point that this Stocks for Interesting Times and make it with one quick slide advance. Put the masks on. There are those in the audience that probably think the guy in the middle is a little overprotected. But Ken always says no costumes for these, and I have to do my best to misbehave. Why don't you go ahead and take care of the legal.
This is an educational demonstration, folks. We are going to mention specific stocks in real time, and our mention doesn't constitute an endorsement to buy, to hold, or to sell. Everything's done as an example of our better investing methods. Securities discussed may be held by each of us in our own portfolios or in portfolios of clubs that we belong to. The Mid-Michigan chapter runs a regular program called the Round Table, and in addition, we run investing topics programs about 6 times a year. If you'd like to be added to our reminder list, drop an email to nkavula1@comcast.net or look at the Mid-Michigan webpage on the Better Investing website and add your name to our guest list. Right now, we're sending reminder notices to almost 1,400 people throughout the country, and we'd like to send one to you about our free events that are held monthly. If you have questions about the slides or would like a copy of the slides, please send an email to markr@manifestinvesting.com. markr@manifestinvesting.com if you'd like a copy of the slides or if you have questions. Thank you.
All right. Some would say we might not have time for this, but I think we have time for this. I just wanted to take a moment and recognize Nicholas Strategos from Pittsburgh, certainly a neighbor to Northeast Ohio. Nick passed away within the last month. And I just want, again, I think a moment of silence would be inappropriate for those of us who knew Nick well. Nick served as a knight on our round table, and he's just been extremely influential in the better investing community for at least a couple of decades. And I just want to say commence resting, buddy. Even though he was a Penguins fan. All right, Ken and I decided we'd paraphrase the guiding principles just a little bit, just to kind of have some editorial license with them. Rule number 1, invest regularly. I mean, it's one of the most powerful things you can do. Convince, especially a young person, to do that in a meticulous and persistent basis. The things we're going to talk about today involve buying and holding excellent growth companies, not forever, like we're often accused of, but for as long as it makes sense to do so. There are times when you want to take advantage of selling opportunities. And last but not least, prudently diversify. And we'll cover the notion of all of the above investing. And Ken would like this to be the agenda.
I think these 4 words really set the tone for what Mark and I fervently believe about investing. You must have perspective, and we would prefer that you have long-term perspective. Everything you do must be within a certain context. You need to understand the stocks that you're going to purchase. You need to understand the stocks that you're going to sell, and you need to understand the context in which you are making that investment decision. You need patience, and most of all, you need discipline. We're long-term investors, and long-term investors can't be bothered by day-to-day or week-to-week or even month-to-month swings in the price of a stock. You must be disciplined.
Well, patience and discipline, I guess I'm out. Those are two huge words for me, and they're for a lot of people. And I think one of the most amazing attributes of the modern investment club movement is how those, well, all four, but especially the patience and discipline part, are definitely promoted. Let's talk a little bit about invest regularly. I just wanted to spend a quick moment. This is actually from a Better Investing column that I wrote back in, I believe, 2003 or something like that. But what it comes down to is just this notion of investing regularly versus comparing the amount that you gain from a lump sum over a relatively flat spot in the market. And back in the 1970s, the Dow Jones Industrial Average basically went nowhere. It had an annualized appreciation rate of 2%. That said, just to make a point, if you had just simply invested $20 a month, and by the way, that's not a arbitrary number. That's what Tom O'Hara, the guy that you heard about a few minutes ago, that award, he invested $20 a month into the Mutual Club of Detroit every single month since February 1948 until I witnessed it in the late 1990s. Just an amazing thing. Just doing that. Now, they picked some great stocks in that time frame. That's a subject for another day. But just doing that raises it up to double-digit returns. And it's just something you can't emphasize enough, that it's a weapon in our arsenal. That's a link to the extended version of the article at the bottom of the page there. And that's a public, that's basically our blog post. Any comments on that, Ken?
Well, I'd like to look at the graph just for a little bit and ask people that if Tom O'Hare had not invested regularly, but had invested in, let's say, 3 different lumps over that 10-year period, and if those lumps came at the top of the market, he would have had much fewer shares to make money on. If he would have invested in 3 lumps that came at the bottom of the market, he would have had a lot more shares to make money on. And by investing regularly, in this case on a monthly basis, he was able to dollar cost average. He was able to get a lot of shares when the market was low, and he didn't buy quite so many when the market was high. It's a great way to build wealth, and it's the way that most investment clubs make their long-term gains over the years of their existence.
Okay, let's go ahead and press on. All right, here's one of my favorite slides. This is literally what we do, where imagination meets vision. And I don't want to say I'm bitter, but this is actually from, I'm capturing a moment from a national convention. By the way, I hope we have one again soon, and that you're all invited. They're a blast, basically meeting for 3 or 4 days where we do nothing but this for 24 hours, 24/7. But just want to reinforce this notion of investing in core companies, and I'll let Ken take it away and do his chant in a minute. But I do want to point out that during this presentation in St. Louis, captured by the St. Louis Post-Dispatch, and I'm not one that holds a grudge or anything, but David Carson didn't capture me in that picture, and he owes me one.
And folks, I've only been hearing about this picture that I didn't take for over 10 years now. So come back and listen to us talk in 10 more years, and we'll probably still be talking about this time. As I moved from local volunteer to national volunteer, I took with me many of the things we do in mid-Michigan. And in the chapter that I belong to, early on in the mid-90s when I started volunteering, we started to chant. And our first chant that we used in beginning clubs and in intermediate clubs and in advanced clubs was to continually remind people of the kind of growth stocks that made up a lion's share of our portfolios. And those stocks had lines, sales lines and earnings lines, that were up and straight and parallel. And eventually up, straight, and parallel became my mantra. And I brought it to the national audience and it was appreciated. And today we hear it all throughout Better Investing. We're looking for good, solid growth stocks that grow at a consistent basis. That makes their lines grow in a straight line in an upward direction. And when the earnings line begins to match the sales line, then Better Investing is working exactly the way that its principles tell us it's supposed to.
Yeah, and the image that's on the upper right there, that is certainly up, straight, and parallel. It's what we learn to look for in core companies. Ken's going to talk about O'Reilly here in a few minutes. That's something that the Mutual Club of Detroit bought back in the 1970s. But again, I think this notion of we cast a vision of what an excellent company looks like, and then we kind of hold their feet to the fire as a steward, as an owner of the company. I did think it was kind of cute that Mr. Carson, a photographer, grabbed us afterwards and said, you know, you guys put those pictures up on the wall and it's like a 4th of July fireworks moment where everybody's going, ooh and ah. And he said, what are you people, some kind of cult? And maybe he's right about that. Some good, clean fun, but obviously this one's not going away anytime soon, Ken, so just deal with it.
Here's one of our up, straight, and parallel candidates, Fastenal, and our long-term perspective is really demonstrated in a great way if you look at the I-bars in this company that accompany the graphs of earnings and of sales. The I-bars are those vertical lines, the black ones, and notice that for a while from 2013 to 2015, the I-bars were declining. Meanwhile, the sales kept themselves on a nice upward trajectory, and the earnings kept themselves on a nice, generally upward trajectory. And if you kept buying stock during that period, or in fact, if you just held on and had patience and discipline, eventually the growth in the sales led the growth in the earnings, and the growth in the earnings led to a great increase in the stock price. Notice the I-bars for the last 5 or 6 years for this company, Fastenal, and remind yourself that you're looking at current data and you're looking at 2 quarters of COVID recession, and you can't see the recession happening. Now, that's not to say that it won't be reflected in future quarters, but I'm telling you that there are plenty of companies out there right now that aren't suffering the complications that you might see in the airline stocks or the restaurant stocks or some of the other stocks that are very sensitive to what happened with COVID. This is a recession like we've never had before, where some companies are doing just fine and other companies are being devastated by staying closed when they need to have people using their services, whatever they happen to be. Here's an example of a company, and it's being rewarded for the fact that its business, up to this point at least, has not been seriously interrupted. Look at those price bars. Here's another company, O'Reilly Automotive. You know what they do. And here's a company that cannot continue to grow its earnings faster than its sales. Notice that the blue line, the earnings line, is steeper than the green line, the sales line. But as long as this is happening, we should be able to continue to have the I-bars moving generally in an upward trajectory. How can O'Reilly do this over this long a period of time? Well, not only does it grow sales from the stores that it has open, but it's adding to its store count on a regular basis, and therefore it's able to not only increase the units being sold at existing stores, but the entire store count base is increasing to give you faster sales growth. I'm sorry, faster earnings growth than sales. Again, here's a company that has not been affected by the crisis, by the recession. There are companies out there, and these are the companies right now that you might be seeking out if you need candidates for your core holdings in your portfolio. Mark, anything to add about O'Reilly?
Yeah, this one's pretty cool because when I joined the Mutual Club of Detroit in the mid-1990s, one of the holdings that they had was O'Reilly that was first purchased back in the early 1970s. And they had spotted this group of people making these auto parts stores that were just exceptional. They were excellent at doing their business. They've been very careful to expand over the years. And it's just a tremendous reminder and an invitation to understand the preferred procedure and the full business model. Tom O'Hara used to say a couple of things. One was, what small companies are we shopping for tonight? What are we finding? More on that later. And the second part is just this notion of, using the preferred procedure. As Ken already mentioned, they've bought back shares. They've also increased their efficiency or their profitability over the years. And it's really kind of cool. The Mutual Club had Aflac from the early 1960s. And it's really kind of cool to sit there in a meeting when your cost basis is 16 cents in a company that you've held for that long. And really cool to share ideas and that type of thing. All right, let's talk a little bit about, we've been talking about core, those up, straight, and parallel companies. And one of our favorite subjects at Manifest Investing, invoking the spirit of Hugh McManus here a little bit, is this notion of investing in companies that are not necessarily up, straight, and parallel. In fact, these can often be more akin to trading. And when I say trading, I don't mean day trading or anything like that, but being willing to sell a company. And the type of companies that fall into this general market securities category, you could also call it non-core, are kind of shown there. There's several different flavors, including early stage investing, those companies that do not have much of a track record yet. We'll talk a little bit more about that. Turnarounds. You've heard Hugh McManus on our roundtable webcast that Ken mentioned a few minutes ago, investing in United Airlines at the trough. You can think back to 10 years ago when Hugh stood at the National Convention and said, I want to buy a bank. I think he said he wanted to own a bank. Well, something like that. Anyhow, Bank of America back then, we all held our noses. That actually turned out to be a pretty good investment. Deep cyclicals. F stands for some company that I can't say in this house because my wife works for Chrysler. You're familiar with that company, right, Ken?
Chrysler or Ford, Mark?
Oh, you said the four-letter word. Would you care to share?
Of course I did.
Would you care to share your adventure on Ford, Ken, about investing in a deep cyclical?
Sure. There are certain times when you have to ask yourself if a company will survive. My sister worked for Ford for many, many years, and during the depths of the 2008-2009 recession, she was in love with Alan Mulally. She decided that he was going to keep Ford out of bankruptcy and that the company was going to have a future. And she and all the other employees at Ford decided they were going to do their part to keep that company solvent. Well, Ford went down to less than 25 cents a share at one point in 2008. We belong to a family investment club. The goal of that club is to put all the grandkids through college and have them graduate with no debt. And to that end, her suggestion was that we put a significant amount of money, about $10,000, which was a lot for us, into Ford stock at the depth of the recession. Well, she's quite persuasive and doesn't give up and keeps on talking until you do what she wants you to do. So that's what we did. We did set a sell point, however. We said that if it ever reached a $14 price, we would get out. Well, we bought a lot of shares at 14 cents a share, and we got out at $14 a share. And in the process, we were able to pay for one of the grandkids almost the entire 4 years at college. I'll tell you, that is not typical better investing philosophy.
Yeah, and in fact,
But Mr. Nicholson suggested, however, that you could put 25% of your money into this type of, and he liked to call it non-traditional. And I love that term because it covers so many different things. But we were doing non-traditional investing, and we were investing a lot less than 25% of the entire worth of the club.
well, I'm going to jump in with the disclaimer. This is not for beginners. If you're out there operating on your first, Robinhood account and doing that type of stuff, you can get massacred. I also know people back in that same time frame that did a similar thing with GM. The same time Ken bought his Ford, they were buying GM and they were left with nothing within a few months. So again, it can be a really turbulent, nasty thing, and it takes some experience and judgment to take care of this stuff. I'm often asked, how much is too little growth to do this type of stuff? George Nicholson often talked about he would become less interested, and I'm quoting, in companies that had 3% or lower growth rates. So that was his definition of low growth. I would say it might even be a little bit lower than that now, but you can find investing or speculating opportunities in lower growth companies and or deep value. One example of that would be Walgreen back about 10 years ago. Hugh McManus and I both featured it in the roundtable, and the whole premise was we thought that they would kiss and make up with Express Scripts because they were having a real feud at the time, and that one worked out pretty well. In fact, it was the best returning investment for the roundtable for the first couple of years. So it can happen. And then other special situations. McManus had he added Staples to the roster to the ledger for the roundtable for several months, several instances where he selected it, and it was based on the premise that it was going to get acquired, taken private by somebody. He was right about that. Unfortunately, the price was much lower than we would have expected, and it was wrong on the price side, but right about what actually happened. And then lately, we've had a stock by the name of Ardelyx. I would just say go out and take a look at it. It doesn't have earnings, or at least not very much when it comes to earnings, but they are in the middle of solving a renal care, kidney challenge, and a couple other things that they're working on, and they're in the middle of some phase 3 stuff right now. But again, we want to emphasize, not for beginners, but it is an opportunity to make considerable returns. But again, it should only be that slice of your portfolio that is truly risk capital.
Mark and I were visiting a model club that meets in Brighton, Michigan, and to that model club came an entire club, about 15 or 18 women, and they basically told us that they were going to disband, and they were looking for advice on what to do in order to disband. After speaking with them, we discovered that they were bored. They were tired of following a portfolio that just kept making small amounts of money in a nice, consistent way. We told them that was a really good thing that was happening, and they shouldn't worry about it too much. But we also introduced them to this balanced type of investing. They really seized on the idea, liked it so much that the next time we visited their club at one of the ladies' homes, we found that they had divided themselves into two groups. One group, which was content to follow the up, straight, and parallel, and that occupied about 70% or so of their portfolio, was being tended by the first group. And the other group was a group of women that was out looking for non-core ideas, ideas exactly like the ones on this page, and they were having a great time managing somewhere between 20 and 30% of their portfolio, making some mistakes, but also making some nice home runs. It's a way to enliven an experienced club that understands the risk involved, because there is risk involved when you move to non-core investing, and it's more risk than there is when you stick with the tried and true up, straight, and parallel. But the Plungers Investment Club really, and they're still around, they really found a way to revitalize themselves by considering this idea of looking at stocks that didn't fit the model exactly the way that Better Investing has sold it for so many years.
Yeah, they certainly have permission. Anybody does that once they reach this point of understanding. But Ken, you left out the part they actually held their club meetings with crime scene tape down the middle of the living room to divide the two groups. So
You're right, Mark. You're right.
They put the tape down on the carpet. It was wonderful. Well, we need to keep rolling, Ken. So let's go do that. This is kind of a busy slide. I'm just going to encapsulate it with this notion that you can go back to look at the original stock selection guides published in the Better Investing. It was the bulletin the first few times out of the box back in the 1950s. And just a quick reminder that they used to graph sales, and you can't really read it on this particular slide, but this is pre-tax profit. Pre-tax profit, basically section 2A graphed on the front side. They didn't even graph earnings. So think about that. Just allow that to be a provocative thought. And we've become kind of enchanted with this notion of computing a projected return on the enterprise value of an organization. And one of the reasons that we like doing this, it incorporates, first of all, the same things you do on every stock selection guide. You basically take a look at the business model and map out the profitability over time. But this actually takes into consideration what you pay for the stock, all of the liabilities, total debt and current liabilities for the company, and any cash that they might have in their checkbook. And you can read the bullet points on the right. We just invite you to come and watch some of the exploring. We're going to share some thoughts on this as we go through the slides here today, but we are doing sessions on this concept, and give you a quick look at one of the reasons I find it interesting. I don't know, I sent this slide to you, Ken. I think it's kind of fascinating. What you're looking at up top is the projected return on value for the 1,400 industrial companies in the Value Line Investment Survey. And then those same companies down below looking at their Section 5 projected annual return. And you can see that there's a little more scatter, a little more volatility in the ones down at the bottom. The PE is the culprit in many of those cases, tax-related accounting in some of the other cases. But I'm just kind of enchanted by this almost perfect bell curve, and the fact that the two kind of resemble each other. So I know what to look for. I mean, we all have a pretty good feel for what projected returns look like over a diverse set of companies. And the fact that these two are similar, perhaps a little bit lower on the projected return on value right now. But I just like the way that those forecasts are shaping up. Any thoughts on that?
Yeah, I will say, Mark, that the concept takes a little bit of time to wrap your arms around and to think it all the way through. But the more you think about it, the more you begin to understand that this might be a way to validate some of your more questionable SSGs, and to give you an alternate source to say, well, you know, I'm getting this number, which is 15 or 18 off my SSG, but I'm getting this number, which is maybe 8 or 9 off the proof calculation. And there has to be a reason for the divergence in the two values. And it gives you something to stand on as you begin to move into the company and ask yourself, what's causing the disparity between a traditional SSG and a slightly different calculation based on actual cash on hand and actual financial situations.
Yeah, it's kind of fascinating. So again, you're invited to explore along with us. One of the places that we're doing this is every Tuesday afternoon, at least for the last couple of months. And going forward, we've been offering these bull session webcasts. And you can actually get more information on them by going to that link, manifestinvesting.com/events. That's a public link. You do not have to be a subscriber to Manifest Investing, although you're all welcome, certainly welcome. But we do kick around this sort of stuff in addition to a number of things. But this has kind of been pretty prevalent for the last couple of months as we try to come to grips, as Ken said, get our arms around this subject. Plus, we like the notion of all those bulls. That investment club up at the top of the page is certainly populated by a bunch of bulls. All right. The other thing that we want to invite you to, and many of the people here in the audience, very familiar names that we know have been at a number of our roundtable webcasts. We just celebrated our 10th anniversary with, we've been picking 4 or 5 stocks per month, every month since July 2010. And what you're looking at here is the results of those selections. We do keep track. And all relative return is a comparison of how you have done versus how you would have done just simply investing into the Wilshire 5000. And you can see that our rate of return is 17.4. By the way, we hit 18 before the market took its hiccup last week, Ken. But that relative return of 6.6% is pretty stellar. It's pretty rare air. And that dotted line across the middle is basically what investment clubs shoot for, basically 5 percentage points better than the general stock market. And we have managed to do that. If you can end up anywhere in this zone, you're doing extremely well as an investor. So again, you're invited to check that out also. We have a lot of fun with the roundtables, and they meet on the last Thursday of every month at 8:30.
Last Tuesday, Mark, last Tuesday.
Oh, that's why I've missed the last couple meetings. Last Tuesday, I knew what I meant. Last Tuesday, 8:30 Eastern time. Just like an investment club, that we try not to change the time so people like me don't. Well, let's move on. Go ahead, Ken.
I discovered this index right here, I don't know, 2 or 3 weeks ago. I was flipping through the channels. I'm staying at home a lot more, as are many of you. And I came across Jim Cramer talking about his COVID-19 index. Well, I've listened to Cramer on and off for the last 5 or 6 years. Sometimes I find that there's a lot of truth to the kinds of things he says. Frankly, I like to read his books more than I like to listen to him. And I think if you read Jim Cramer's books on investing, you will remind yourself that he's a closet better investing member. He believes most of the same things we believe. He believes that in order to be a good investor, you have to do some homework, and he shows you how to do that homework in order to make good investments. He put together an index that basically talked about the 100 companies he felt would benefit, would do well in the COVID shutdown, which had just occurred when he put the index together. The graph shows growth since the beginning of January, but the index wasn't actually established until somewhere around the middle of March. So at one of the low points right there in the middle of the March, that was when the index was put together. Here's the top performers since then. In other words, he's picked very wisely in some of the companies that you might want to take a look at. Now, I'm not going to tell you that these are all better investing type investments. I will tell you that a good, better investing portfolio can probably contain 1 or 2 or 3 of the companies at the top of this list. I know that between clubs that I belong to and my personal portfolios, I know that I own 4 of these companies. Some of the names might be very familiar to you, and some might be completely unknown. Here's a good source of ideas, and it's an especially good source of those kind of non-traditional ideas. It's an especially good source of some of these companies that are just emerging into profitability. They're moving from being not profitable, from actually losing money in each quarter, to becoming profitable. And you know from our business model discussions and studies that that's the time, if you can discover a company, when you have the chance for explosive growth going forward. Here's a great list of stocks to take a look at, and especially if you want some non-traditional candidates, here's a great list of non-traditional candidates. The recent pullback might have given you pause to say to yourself, I think that some of these are a little bit cheaper than maybe they were even 2 weeks ago. And I will take a look at one or two of these companies. Some of the companies will make you gasp when you look at their PE values, and many of them don't have a PE because they don't have any E. But that doesn't mean that you shouldn't be thinking about companies like this and constantly looking for companies as they become profitable, as they start to have an E in that PE fraction.
Yeah, just a couple of highlights on this. First of all, you can see all 100 companies using that public link at the bottom of the page. Second of all, I think the portfolio is up 60 to 65% from when he actually selected it back in March. What I find fascinating is only 4 or 5 of the companies have actually lost ground. And you can see from some of those percentages, it's actually quite phenomenal. It's one of the best examples I've seen in a long time of theme-based investing. And take a look. I would also let everybody know that in mid-August, he said he was basically backing off the theme a little bit. He'll probably come out with another new theme, but again, be careful. Some of these have had quite a run. All right, ready to trudge ahead, Ken?
I am, Mark.
All right, let's talk about the Value Line Arithmetic Index. Again, this is the 1,700 companies in the Value Line Investment Survey, equally weighted, what they have done over the last 10 years, going into the really ugly moments in March and April just a few months ago. Compare that to the 10 years leading up to what is known as the Great Recession. I'm still trying to figure out what was great about it, but the values, that same Value Line Index, and what happened as the Great Recession hit in 2008, 2009. Just to put a timestamp on it, I went back and looked and tried to figure out, well, what were people watching. I don't even remember the movie Frequently Asked Questions About Time Travel. And they said it was one of the most viewed movies back in 2009, and on TV people were watching. Trust me, don't think I watched that one either. I must have been too busy shopping for stocks. But that gives you some feel for the time frame. And what I want to make the case, I'm quite often very reluctant to put up slides and say, hey, this looks like 1936 or, whatever. But it's kind of hard to ignore the fact that these two, and by the way, there's Henry Gold's San Francisco Fires on the upper left there in this orangey sky. Those two are pretty similar, wouldn't you say, Ken?
I would, Mark. I'd like to draw people's attention to those graphs above the colored graph, above the graph that shows price. Those are relative strength index graphs. I'm not a big proponent of technical analysis, but I've come to believe that watching relative strength gives me a little bit of an edge when it comes to making a stock purchase. The traditional wisdom is that when relative strength, which is kind of a measure of momentum, not kind of, it is a measure of momentum of stock prices moving up for a specified period of time. When relative strength moves above 70, that's a signal to perhaps sell a stock, and it can stay above 70 for quite a long period of time, for a month, even a 2-month period sometimes. And when relative strength moves below 30, that's an indicator that you might want to be looking to buy a stock. Mark and I have both been looking at what happens to shares when that relative strength moves above 80 or moves below 20. We think those are exceptional opportunities to buy or sell, and we've been kind of honing in on stocks that are in those two areas right now. Now, not every stock with a relative strength above 80 is a sell, and not every stock with a relative strength below 20 is a buy. You still have to do your due diligence. I still do stock selection guides, and in fact, I take a deeper dive many times when the relative strength is at extremes like that. I want to understand what I'm buying or what I'm selling. But again, here's a way to maybe get a leg up on some stocks that you might want to invest in, either from the buy side or from the sell side.
Yeah, and in a shameless commercial, we're going to cover that topic, including a look back at some of the relative strength RSI leaders back in March, and it's just a wow moment. So we're going to cover that at a future bull session here fairly soon. What I'd like to do right now is kind of invite the audience to close your eyes and think back to what you were doing back in Thanksgiving 2008, Christmas 2008, and actually as St. Patrick's Day approached in 2009, how nasty that period was. And in fact, that was a period in time when Ken and I would spend more time than usual on the phone or wrestling with each other as we rolled down the highways, because it was a tough time in the market. So back during that time in the market, going to show you two slides here. This is actually a collection of the consensus selections for our February 2009 Groundhog Challenge. And you see some household names, some community favorites from top to bottom. There's a couple that sneak in there that are a little less well known. But from top to bottom, I think it's pretty easy to notice that some of these numbers are stratospheric. We're talking about returns in the 20s and 30s. I would do a stock selection guide, end up with an upside-downside ratio of 20, and I'd call Ken. Do you remember those days, Ken?
I absolutely do, Mark, because we were getting unbelievable par values for stocks that we had followed for years and years. Our chapter was running a stock session on a monthly basis at a local library where we were attracting 70 and 80 and 90 people. As the market got worse, our audiences got larger, and we began to identify stocks that we had always wanted to own that we never could get to say buy on a stock selection guide on a reasonable SSG, and suddenly they were in the buy zone. And I finished one of those stock forums, and I'd come home, and the next morning I'd be on the phone with Mark asking him to validate the numbers that we were getting when we sat in those sessions and did SSGs on the fly. It was an exciting time to invest. And at the same time, we had no idea whether we were going to turn out the kind of results that we thought we were going to turn out.
Okay, so with that thought, keep in mind that this is not fiction. This is documented. This is selections by members of our stock picking community back in February 2009, and now leaving the companies in the same order, showing what actually happened for the next 10 years. And I would just draw your attention to the fact that, wow, the numbers kind of speak for themselves. One company, Navalier, was taken private. That's actually a mutual fund that was taken private. Buffalo Wild Wings was acquired by Arby's. You can read the notes down there, but the bottom line is, wow, what happened and what materialized over the next 10 years is actually kind of in defiance of the rule of five. The only one I would argue that really had tremendous difficulty was Next Gen Healthcare, and that's the old Quality Systems, QSII, that many of us are painfully familiar with. So, Ken, I'm showing we're at about 40 minutes in, so let's go ahead and keep rolling. You have any other comments on this one?
Nope. It's a great slide, though. Great slide.
Yeah, I would just encourage the audience to compare the two and just revel in the reality that it seems to work.
I think it's an opportune time, Mark, to remind folks that if they want copies of these slides, drop an email at the end of the presentation to Mark R. at manifestinvesting.com, and he'll be glad to send copies of the slides out to you. It just seemed opportune at that moment to say that again, so I'm sorry for interrupting. Go on, Mark.
It works for me. All right, let's talk about what we do and why it works. Okay, what you're looking at here is something that we put together on, again, on just the industrials, the value line companies. There's about 1,400 companies. We're looking at their median profitability, their percent net margin over time. And this is basically what happens back in that 2008, 2009 moment. That's why your stock selection guides get massacred. We're in the middle of one of those again right now. That recession is actually a recession in progress, and it's still to be determined how long that will last. All right, what if? I'm giving you the nutshell version of this, and it's so powerful. What if you could just concentrate on community favorites? What you're looking at here is the 40 most widely followed companies by our subscribers. And the tracking portfolio for the Manifest 40, the public link is up at the top. But the bottom line here is simply that, you know, where did all the ugly moments go? And look at how wonderful that blue line looks. And, you know, with the companies that we deem to be high quality and attractive in our studies, they quite often are these companies that tend to do this. And again, side by side, I think this is one of the most powerful slides that we have ever put together, because you're comparing the general population of stocks up at the top with those recessions on the chart. And I want you just to compare the two. And notice the consistency. We like straight lines on stock selection guides. And even more importantly, look at the numbers. There's a scale change here. I mean, it just literally... Go ahead, Ken.
I want to drive that scale change home. That blue line in the top graph ends just above 8%. So that's the perceived growth out to 2024, just above 8% for a typical stock. The blue line on the bottom, on the most widely followed 40, that ends just under 20%. And that's not an insignificant difference. 8 to 20. A little bit above 8 to a little bit below 20, but you're still better than 10 points difference between those two values. That's the kind of plus you can get by confining yourself to the types of stocks that better investing suggests are going to give you the best results.
It's a powerful slide. All right. And this could just kind of wrap up the discussion with some of what's been going on in the general stock market. Again, we're looking at that value line arithmetic average over the last, in this case, 20 years. And I just want to point out that the S&P 500, the blue chart is the S&P 500, has been red hot. I mean, after taking a decade off with the lost decade, it has been red hot like we've not seen in quite a while. We did see a little bit of this type of behavior back in the 1990s, but it has been red hot. So we had counseled 10 years ago to double down on seeking the blue chips, the deep blue chips. We would kind of back away from that now and say, search for opportunities in some of the smaller companies. Another chart making the same point, in this case over 25 years. I included the dogs for Ken, small, medium, and large dogs. And again, just pointing out over the long term how well the value line arithmetic index has done. That's the black line up at the top. And the three different types of companies or stocks, the blue, that's the S&P 500. The red is the faster growing S&P 600. Those are the smaller companies. And the green are the mid-cap or medium-sized companies that we love, and they actually do a great job in our portfolios. The green and the red, the medium-sized and the smaller-sized companies have been massacred, while a lot of the other companies have prospered in this last several months. So again, just a reminder that we believe in investing in all of the above. And when we say all of the above, we mean small, medium, and large. Your thoughts, Ken?
I just want to emphasize how important that is. And whether you measure small, medium, and large by amount of goods and services sold, or whether you measure it by the growth in sales, either method ends up putting you into those three categories of stocks. And without investing in those three categories of stocks, the small stocks, the medium-sized stocks, and the large stocks, without investing in those kind of stocks, you're going to have a hard time meeting that better investing goal of 15% for your investment club. It's just going to be almost impossible if you stick to only large blue chip stocks.
Absolutely. All right, Ken, I'm showing that we have about 10 minutes left. Of 10 after, we were going to try to be done at 20 after. So why don't you go ahead and show us where to find some of those smaller opportunities?
Well, this is our SSG Plus tool, and I'm on the, if you click once, Mark, I'm on the Spyglass, and the Spyglass takes you to the screener. And there's actually 3 different types of screeners on this page. I'm going to focus, click again, Mark, if you would. I'm going to focus on the predefined screens, and click again, please, Mark. And we're going to look just at the small company screener, and click once more, if you would, Mark. And when I click that button that said small company, this is what comes up. Now, I want to be quite clear. On a typical day, in a typical month, in a typical year, this screen gives me 15 to 20, even 25 different companies. Right now, in the middle of the recession, with many companies closed down completely and COVID keeping us at home, this screen only gives me 7 results. But there's still companies that might be of interest if you're looking for great small companies. Now, I want to caution you. Way back when, maybe 15 years ago, I bought a company called Hogs, H-O-G-S. It looked up, straight, and parallel. It was beautiful in everything I could read about the company. I looked at pictures of its main office in mainland China, and I looked at all of the results that they had written copiously about and how great this hog producer was to the largest hog consuming nation in the world. It turns out Hogs was a complete sham. It didn't exist. Even the pictures of its main offices were fake. And of course, that made for a bad investment. There are some Chinese companies right on this list, and you need to be very careful when you're looking at a Chinese company. But there are also some great American small companies on this list. I think if nothing else, it begins to show you the kinds of companies that do exist, even if you're a small company investor. And if you can find a small company as it becomes profitable in its early years, and I've said it before, today I've said it, then you can ride that profitability and you can ride the explosive growth which comes as the company goes from small to medium size and beyond. Right now, there's only 7 companies on this list. They're not all American, but I would take at least 15 or 20 minutes and explore the websites of each of these 7. Get to know these companies, because when you look at their visual analysis, I think you're going to be pretty impressed. Many of them have huge PE values attached to them right now. That's fairly normal for a company moving from unprofitability to profitability. What you want to do is begin to understand that you need to expect the same from your small companies as you are expecting of your medium-sized and large companies. And if they're core companies, companies that you want to hold for a long period of time, then you're going to still be looking for that up, straight, and parallel model, no matter what the size of the company.
Good segue, Ken. All right, let me just give you we'll spend just a couple minutes on this. This is actually we call this a parade of opinions. And what I have done here is I've asked our database to basically show me companies that are in that higher projected return on value, basically double digits. But I want, just like Ken was saying, companies that have double digit growth rates and quality above 70. And lo and behold, global cord blood, we'll spend a minute with that here in a second, ends up at the top of the list with a interesting number. Got to be wrong. We'll talk about that. Maybe not. Anyhow, you're looking at a list of companies that have fairly decent return forecasts, double-digit growth rates, fairly good quality. They're going to look pretty good on stock selection guides. And from top to bottom in the pre-session, we were talking a bit about Essent Group, ESNT. D.R. Horton, ticker symbol DHI, is worthy of closer study with all that's going on in the housing industry and all the homes that are going to have to be rebuilt out west. Number of insurance companies are showing up at the top of the list, worthy of attention. MKS Instruments, that's a diagnostics type company, instrumentation, that was presented by Cy Lynch at one of the roundtables about 4 months ago. Anyhow, these are some pretty good companies to study. And again, I wanted to take just a moment for global cord blood, because I'd never heard of the company until we saw it yesterday. We did add it to the manifest database. You can see where the visual analysis is compelling. Do you agree with that, Ken?
Oh, absolutely, Mark. Yeah.
Everything looks pretty good. I mean, I'm chilled by you're talking about the hogs company that didn't exist. The one thing that I find compelling, and I do not know the answer to this question, do they really have $785 million in their checkbook? Because it really throws the projected return on value into a tizzy. Because again, I'm just wondering if this isn't one of those Benjamin Graham companies. Because keep in mind that cash in their checkbook is about $6 or $7 per share, and the company's selling for $3 a share.
What rings with me, Mark, is that if they're another Hawks, if they're another shell company, then they could write any number they want in his reports.
That's the thing. I mean,
once burned, twice shy. Yeah.
Yeah, and my wife has basically said no way, no how, because of your experience, Ken. But again, I'm intrigued. I want to figure out if that's real or not. I would typically go and see what other institutional investors are tracking this company, but even the institutional investors got fooled by hogs 10 years ago. I mean, the hedge fund managers and mutual fund managers, they had people on the ground, and they got fooled by it. Here's a brief description of what they do. Here's the red flag that says the magic word. Yeah, there's a whole lot going on in that environment for investing. Can't even call it investing. It's got to be speculation if it involves China. But down at the bottom, Ken, I don't know. Is Hong Kong really part of China? I don't know. It's an interesting company. It's basically a blood bank that does some stem cell stuff. But I find that picture compelling. The mystery of, do they really have that much cash? Because I don't know if any of you out there want to give me a dollar bill for a quarter. Every quarter that I send to you, you're going to send me a dollar bill. I'm very interested in that. All right. I was going to talk about Ralph Lauren, but long story short, anytime you're in an economic disruption like we are right now, take a look at the profitability for Ralph Lauren. Keep in mind that the company is reconfiguring. You really have to spend a whole lot of time thinking about relevant recent history. Try to look beyond the chasm and do your study with those things in mind. That's the whole message I had for Ralph. We're in the middle of that recession. There's that relative strength index that Ken was talking about just a few months ago, suggesting that, oh, by the way, a price somewhere in that 70 range might be attractive. And I believe they're at 76 right now. So with that, Ken, I think we can leave for questions. One last slide on Amazon comparing 3 different approaches. The top being a cash flow based projected return on value. It's an SSG done with cash flow instead of earnings. just as Mr. Nicholson would have prescribed for an emerging or a deep cyclical. The projected return on value through the middle, and then the type of pattern that we see quite often from Morningstar, Value Line, or many better investing people who believed in PEs for companies like Amazon a few years ago. I mean, one of our favorite things to point out is that Hugh McManus selected Amazon at the National Convention in Chicago about 5 years ago, and didn't get a single vote from the audience after making the selection for the roundtable, and it's actually turned out to be one of the best performing selections in the history of the roundtable. We can come back to that if there's time for questions. I just wanted to point out that if you're intrigued by this return on value concept, quick reminder that there's 104 shopping days left until Christmas first. And you can actually go to YouTube, search Manifest Investing, and look for this video where we unleashed the topic. And in fact, a month later came back with Nick Strategos, who we talked about during the beginning, where he actually talked about auditing a stock selection guide using this return on value or return on capital question. All right, and with that, Ken, do you want to close with this one and some closing thoughts?
Yeah, I think that many times we get the idea that the stock market is an even bet, 50-50 plus minus, and we've just put together a really simple histogram, bar graph here, that shows the up years in the S&P 500 and the down years in the S&P 500. Those are 10% jumps across the scale in the bottom there. And that looks pretty much like a bell curve to me, or the beginnings of a pretty good bell curve. The graphs start at the World War II, at the beginning of World War II, when regulation was first introduced to the stock market in a meaningful way. And you can notice that the average price of the gain in the S&P 500 is somewhere between 10 and 20%. It's not somewhere around zero, as it would have to be if this were a 50-50 kind of thing you were dealing with. The number of negative years is relatively small compared to the number of positive years. And I will tell you, you can increase this histogram and you can talk about 3-year time periods and 5-year time periods. And as the time periods become longer, the negatives reduce themselves, so that when you begin to talk about 5-year periods, there are only 2 5-year periods since 1940 when the market was negative, and the negative values are less than 5% in both of those periods. So long-term investors have the advantage, I guess is a great word to use, and the average stock is going to return somewhere, depending on how you measure the return. It's going to return somewhere around 10 or 11%. That number's held since 1940. In fact, I think it's held since around 1900, and it's continuing to hold even through these very unusual times, starting in 2008 and moving through 2020 right now. We will take a couple of questions if there are any. Bob or Kathleen, are there any questions you'd like us to answer?
Yes, we've got a couple there. Let's see, Cheryl just asked, can you explain the projected pre-tax profit versus pre-tax profit, the magenta line on the prove equation? She didn't give me a slide number. Are you able to go back to that?
Yeah, just real quickly, it's no different than.
I think she was talking, Mark, about that Amazon slide.
Yeah, let's go to that then.
Right here, yeah.
Yeah, so, yeah, what it boils down to is when you do a stock study, you end up with that magenta line. That magenta line is the pre-tax income or pre-tax profit on sales over time. And just basically using that number, using that piece of data, that piece of reality in this calculation helps to take away some of the capital structure effects, some of the tax accounting effects that really screw up earnings numbers for many companies. And when earnings numbers get disrupted, so do PEs. So what you're doing is sidestepping that type of stuff. And again, I believe it's probably a core reason that people like George Nicholson and Arnold Bernard, the founder of Value Line, chose to avoid earnings, sticking with cash flow or pre-tax income as a different way to approach looking at the picture. And again, it really does come back to, well, Ken, I think you left off the magenta lines today, didn't you?
Yes, I did.
Yeah.
To focus on sales and earnings.
But I'll put this slide up just because it makes the point of, again, these two lines are the revenues and pre-tax profit, pre-tax income per share. Okay.
Okay, and one other, Steven's asking, what is your criterion for alpha in a stock?
Ken, you want to handle that, or do you want me to?
Well, sure. Alpha is a term for profit, and I assume that's the way he's using it. And my criteria is to look at alpha in comparison to what the average stock in the market is doing on any particular day. Value Line measures an approximation for the stocks in the Value Line survey. The 1,700 stocks in the Value Line survey. Manifest Investing measures an average return day by day. They call it MyPar. And if that average return is 10%, which it has been over long periods of time, then my criteria is to try to beat that 10% return by 5 points. So I'm aiming at 15% return. Now, that's in the aggregate for a portfolio. And my expectations would be a little bit less for a larger stock and a little bit more for a smaller stock. But all in all, I would expect the portfolio to perform 5 points above the market. Recently, the market averages have been lower than 10%. We're in a place right now where there's some overvaluation, in my opinion, and therefore that pushes the expectations into the future down. And if you're looking then at, say, an 8% average return for a stock, then my goal would be to still beat the market by 5 points, and I'm looking at 5% for the market. I tell the story of visiting a club that had just come out of the 2008-2009 recession with a return of only 3%, and they were going to close up. They were very depressed because that was nowhere near the return of 15% that Better Investing suggested they have. And we were able to convince them that 3% was a noble return when the market was losing 30%. And that in fact they should continue to not only compare their returns to that 15%, which is based on long-term averages, but they should also be looking at shorter term because that is going to determine what their year by year goals might very well have to be. I hope that comes close to answering the question that he asked.
I think it does, Ken. Alpha is simply a positive relative return.
Yeah.
Well, alphas can't be negative. It is the relative return. And to answer his question, we basically aim for stocks that are 5 percentage points. That's 500 basis points better than the average market, as you described, Ken. Thanks, Bob.
Well, Bob, we'd like to thank you and the folks in the back room. Folks, you can never do a broadcast without having a group of folks behind you that are answering technical questions and keeping things moving right along. We'd like to thank the members from Northeast Ohio, Kathleen especially, for affording us the opportunity to speak with you today. We wish that it would have been face-to-face. This was supposed to be a face-to-face meeting, but maybe we can have the idea of next year in Cleveland, okay? Mark, any parting thoughts?
No, I say have a great weekend. I'd like to send some of this snow out in the way of San Francisco. I think they could use a little bit of that falling on California, but just want to thank everybody for coming out and invite you to continue to explore successful investing with this wonderful group of people. Thanks so much, everybody.
I will make the point that this will be posted on YouTube as a recording, and we'll try to get it up on YouTube in the next couple of days. Remember, I'm a volunteer and Mark has a full-time job, so we will get it up there, but it won't be immediately, but it will be on YouTube in the next couple of days. Manifest Investing Roundtable is the YouTube channel.
Give it back to Kathleen, I guess.
Thank you, Mark.
Yeah.
We're turning the meeting now over to David Roach, president of the Model Wheeler Dealer Investment Club in Cleveland, Ohio. Dave? Unmute yourself.
And Bob, while he's doing that, I think we wanted to stop the recording for this part of the session. Is that correct?
Yes, I'm going to do that right now.